When considering a mortgage, homeowners are frequently tasked with deciding between an interest-only loan and a conventional loan. But what exactly are the differences? This video will break down the advantages and disadvantages of both, starting right now. First, conventional loans. It's by far the most common loan type. You probably have one. 15 or 30 years. Principal, interest, taxes, insurance, PITI. They're going to be issued by a bank or mortgage company. On the flip side, interest-only loans. Now, I'm willing to bet almost no one watching this video has one, but if you do, more power to you. Interest-only loans are exactly what they say they are. You get a mortgage, 30 years, 40 years, and you've got an intro period, maybe 5 to 10 years where you're only paying the interest and no principal. But you got to be careful because these are hard things to manage, particularly when you have to start repaying the principal starting after the first 5 to 10 years. Now let's look at the advantages and disadvantages of both one at a time. First, with conventional. The advantages of conventional include equity appreciation. Now, using logic here, the more you pay down the loan and given more time, most likely that property will go up in value, giving you even more equity. It's a beautiful word, one of my favorite in the vocabulary. A second benefit is predictable payments. Borrowers with conventional loans benefit from predictable monthly payments. You know what it's going to be every month. This helps with financial planning, planning for expenses, planning for what's down the road. And it also helps in a rising interest rate environment because your interest rate is locked. Lastly, lower overall cost. While the monthly payment may be higher, as long as you stay in the house for a long time, you're actually going to wind up paying less overall than you would with an interest-only loan. Next, we move into the advantages of interest-only loans. First, lower initial payment. That's it. It has a lower initial payment because you're only paying the interest portion of the loan, not the principal. But you got to be careful because once the principal payments start kicking in, could spell trouble. Next, flexibility. Something I am not known for, being flexible, but interest-only loans are. Why? You're only paying the interest first. That's going to be a common theme here. So that frees you up to pay other things, to save, for bills, or planning for other investments. Lastly, the potential for investment growth. Hopefully your returns are going to be higher here. Hopefully if you've went out and bought a property interest-only payments wise, hopefully that property is going to go up in value, juicing your ROI. So it's something that could be ideal if you're looking to buy a place. Now we've talked about the advantages of both, but like anything in life, there's disadvantages. So let's hop into that with the conventional loans. First, higher initial payments. If you got a tight budget, if you're in sales and your income is variable, like me, this may not be the thing for you. Why? You've got a principal and interest payment every single month, so it's going to add up. Next, less flexibility. You've got to commit to higher payments between your principal and interest payments every single month. So if that's not ideal for you, you may not be up for a conventional loan. Lastly, stricter qualification standards. Conventional loans often come with stricter qualifications than do interest-only loans. They're going to look at your DTI, look at your credit scores even more in depth. So just be aware if you're going down that road. Next, the disadvantages of interest-only loans. The biggest drawback with interest-only loans is the initial lack of equity building. You're only paying the interest the first 5 to 10 years. You're not paying any principal. So you better hope that at worst the property goes sideways, at best goes up. But if at worst it goes down, you could be in a situation where you're making payments on a house where the value is less than the loan. Next, payment shock. Once the interest-only period ends, your payment's going up. I mean, that's a big part of this. If you think you'll get payment shock, if you think it's gonna just crush you and your budget, don't do an interest-only loan because of payment shock. Lastly, higher long-term cost. You can get a 30-year loan, you can get a 40-year loan with interest only in the first 5 to 10 years. So once you do that, you're going to have more time making bigger payments, paying off that principal. You'll pay interest, which is great, but you're not paying on the principal initially. So by the time you do start paying on it, you're probably going to pay way more overall than you would with a conventional loan. Choosing between interest-only loans and conventional loans is a big decision. And for most people, most likely every single person watching this has a conventional loan. I only know a few people with interest-only loans, and they're usually not always high net worth individuals who can take that money, who have the connections, have the people, have whatever, and know where to plug it. So if you are going to go down that road, be careful. Don't get an interest-only loan and go bet on some crazy stocks or buy puts or calls. If you're going to do it, put it into something safe. Most likely you should go the conventional route. It's what I've always done. It's what I'll probably always do. And as always, you should keep tuning into the Think Brad channel. We're coming right up on 1,000 subscribers. And we may even probably do a giveaway where we're giving a small gift to the 1,000 subscriber. So check us out, leave us a comment, let us know where we can do better, give us some video content ideas, because quite frankly, I might be running out of them. Not really. But anyways, stay tuned. We'll see you soon. All the best. Cheers.